The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening. Hi, it's Dane Pimble here from Own Financial Planning, and joining me today is Eleanor Swanson, Portfolio Manager of the Firetrail Australian Small Companies Fund. Eleanor came across from the team at Macquarie and was one of the founding partners of Firetrail in 2018. And today we're going to be talking about some of the opportunities in domestic small caps. Over to you, Eleanor.
Great. Thank you very much, Dane. It's great to have the opportunity to touch on what we're seeing in the small cap market today. So there's really three parts to today's presentation. We'll firstly go through why we think now is a really good time to be looking at the Australian small cap market. I'll then go through two of the highest conviction positions in the fund today. And then finally, we'll just touch on the track record of the fund since inception at Firetrail, but also from our time managing the fund at Macquarie.
Brilliant.
Perfect. All right. So getting into it. So I think this is very important to be considering for asset allocators. And on the left-hand side, what we've done is we've basically broken down the large cap part of the market, or the ASX 200, those top 200 companies in Australia. And we often hear in the press, global investors, particularly in the US, talking about the concentration of their market. You know, we hear Nvidia, Apple, some of these really high quality growth companies, and now 35% of their index. But this level of concentration is something we're very used to in Australia. So you can see on that pie chart that the top 10 companies in Australia are almost 50% of the ASX 200. So we've got incredibly high level of concentration in the local domestic market. But more importantly, you can see in the chart on the right, this is the valuation of those top 10 companies. So what we've done here is we've taken the 10-year average price to earnings multiple for these companies. And we've looked at where they're trading relative to that 10-year average. And you can see that these 10 companies are very expensive versus history. The only one that screens cheap is CSL. Now, this is important given that concentration. If these companies, for example, the big banks, which we all know have had a big run over the last 12 or so months, if these companies start to revert to kind of their more historical valuation levels, that can really hurt investors in the large cap part of the market. So I think it is really important to just be aware of that risk that sits within the large cap market. Now, in contrast, taking a look at the small cap index. So this is the 100th largest company right down to the 300th largest company in Australia. That's what we're talking about when we talk about the Australian Small Ords benchmark. And you can see that that benchmark is very highly diversified. So the top 10 companies in that index make up only 14% of the index. So you don't have that concentration risk. We're not having to take any big bets on the banks or the big mining companies. Now, importantly, for investors considering allocating to the small cap benchmark, the benchmark also screens incredibly cheap, not just domestically, but on a global level. So what we've done here is we've taken the price to earnings multiple, the average price to earnings multiple of a range of indices globally. And you can see that the ASX 100 does screen incredibly cheap. And we've divided that price to earnings multiple by the 3-year growth outlook for those indices. And you can see that the Small Ords benchmark in Australia screens incredibly cheap globally. So as we stand here today, we're very excited about the small cap market and the potential returns on offer looking out over the next 2 to 3 years. I'll just briefly touch on this slide because I think it is an important one. This is basically the 20-year track record of the small cap market in Australia. You can see that that's in orange. And it's delivered investors a pretty lackluster 5% per annum, not terribly exciting. You can see that the ASX 100 return has been higher at close to 9%. But I think the key point of this slide is that the median active small cap manager in Australia has delivered investors 11% per annum return. And I think that what that should tell you is that the small cap part of the market, there are a lot of bombs in that part of the market. There are a lot of companies that you want to avoid, stretched balance sheets, business models that just aren't fit for purpose. And so you really do want to be active when you're investing in the small cap part of the benchmark. So we do think the outlook for small caps is massively improved. But importantly, you do want to have that active overlay when investing here.
Fantastic. Thanks, Eleanor. And can you talk us through the Firetrail team?
Yes, absolutely. So I think this slide is useful just in framing up how the Firetrail small cap team is different to our peers in the market. So if you look on the left-hand side, we've broken down the index again. We've broken it down in a different way, however. We've basically broken it down into 3 key sectors or buckets. So we've actually gone through all the Morningstar data, and we can see that about 2/3 of our peers don't invest in the biotech or resources part of the market. They really do concentrate on those industrial companies, your household names like a Nick Scali or a Bega Cheese. There's really good returns on offer in that part of the market. We've got some great companies in Australia that sit there. However, there is a very large missed opportunity in the resources part of the market and also in biotech. So we're able to tap into that part of the market due to our expertise that we have in the fund. You can see 2 photos on the right. So on the right-hand far right is Matthew Fist, who's co-portfolio manager of the fund. He's there in a high vis on site at BHP. He worked in the mining sector for over 5 years, underground and above ground. And so he's got that expertise to sit down with a mining CEO and actually run through their operational plans, their production forecasts, and even look at some of those early stage drill results and make an assessment as to whether he thinks there's fundamental upside for those companies, rather than just, maybe a top-down view of the commodity, which is what a lot of people tend to do. On the left-hand side, that's a photo of myself. I'm standing on a CT scanner there. So my background is I'm a trained immunobiologist. So that means I've spent a lot of time in the lab looking at clinical trial data, and that's incredibly useful skill when it comes to looking at some of these early stage biotechs. We've got some very high quality companies in that biotech space in Australia by virtue of our university system. And if you get those stocks right, they are high risk, so we size the positions accordingly. But if you get those right, there's a lot of alpha potential in that biotech space. So I think the proof is in the pudding. You can see on the right-hand side, what we've done is taken our performance since inception and actually broken it down by sector. And you can see that the team's added value in all parts of the market, not just that industrial space, but you're getting that extra cream on top with that biotech resources alpha. So that's really, in a nutshell, how we're different to peers.
Fantastic. So good spread, good diversity of expertise, and that's reflected in that consistent performance. Coming to the present now, are you able to talk us through a couple of your high conviction stock ideas?
Yes, this is our favorite bit, talking about stocks. So the first company I'll present today, you might not have heard of it. It's a technology company called Gentrack. So they're dual listed in New Zealand and Australia. And what the company does is provides customer billing software to large utility companies globally, which basically allows the utility companies to interact with their customers, both in the kind of B2C retail space and in the B2B space as well. Now, why we think there's a really exciting opportunity for Gentrack over the next decade is the energy transition that's taking place globally. So if you look on the left, that's the energy distribution model of yesterday. You had your typical power plant that would push electricity out to your customers. It was a one-way interaction and pretty straightforward. So not much innovation in terms of customer billing there. But what's happening, and it's well underway globally, is this transition to renewable energy. So we've got solar farms coming online, we've got wind turbines. We also need to add storage capacity to the grid to try and help with that kind of intermittent nature of some of those renewable energy sources. To make matters even more complicated, we've got houses now with solar panels, which are pushing energy back into the grid. And those customers are actually wanting to receive a price for that energy. We've got smart meters. Consumers are wanting to know what proportion of their energy is coming from renewable sources versus not. So there's just a huge amount of complexity, and it's triggering these large energy utilities to look at their customer billing software, to look at their customer relationship software, and actually go, is this fit for purpose? And am I able to service my customers the way they're expecting? So taking a look at the kind of, I guess, state of play globally, you can see on the left-hand side that currently about 75% of the market or energy utility companies are using legacy technology providers such as SAP and Oracle. They've been around for a long time. It's on-prem software, so it's very difficult to roll out a software update. Actually, these energy utility companies are having to spend $20, $30 million if they want to implement a change. They're having to bring in external consultants and actually get the tech built. So it's just not fit for purpose. And what we're already starting to see play out in some of these more developed markets like New Zealand, the United Kingdom, and Australia is that a huge amount of these energy utility companies have already moved off SAP and Oracle, and they've moved on to companies like Kraken and Gentrack, which are cloud native software companies. They've actually built technology that's able to deal with things like solar pricing and dynamic pricing. And so what we're expecting over the next decade is that energy utility companies globally are going to be moving on to these cloud-based technology platforms. So it's just this huge market share opportunity for Gentrack. They've got a huge market position in New Zealand. They've got about 70% share of that market. In the United Kingdom, they've got about 50% share of the B2B market. And in Australia, they've got about 20% share of the B2C market. So they're in a really strong position. Even more exciting, if we stack Gentrack up next to a bunch of Australian technology companies, you can see that it's right up there in terms of its sales growth outlook. But even more exciting is that it's trading at less than half the EV to sales multiples of some of these household technology names. So we do think that over the next decade, everybody's going to be talking about Gentrack and know what this company is. So it's a top 10 holding in the fund, and we're very excited about the outlook for this one. So switching gears a little bit, looking at the healthcare space. So this is a company that provides imaging services to doctors and specialists. So Integral Diagnostics, it's actually just recently done an acquisition of Capital Health. So it's going to become a much larger company imminently. But what we're seeing is an interesting opportunity in Integral Diagnostics that we think the market hasn't really cottoned onto, is that it's got a massive opportunity to drive efficiency in its business through artificial intelligence. So if you look on the left-hand side, what we've got here is a basket of stocks such as NextDC, Macquarie Technology, data center providers that have had a huge run off the back of this AI thematic. In contrast, you can see Integral hasn't done a huge amount over the past year. So we think the market's missing this opportunity. And why we think it's a huge opportunity, you can see on the right that the profit margins for Integral have been absolutely slammed over the last 2 years. And that's because of the employee costs, particularly that radiologist cost line, have been blowing out. So using AI, we think they can get those costs down. Why we like IDX, just in a nutshell, it's part of a very structural growth industry. Over the past decade, it's grown at 7% per annum. That's by virtue of the fact that there's Medicare indexation at about 3%. You've also got a mix shift to higher modality imaging such as MRI, CT, and then you've also got that aging population tailwind giving you some nice volume growth. So it's got really good top line growth without having to do much in terms of market share. But in contrast to the pathology market, the imaging market is not very concentrated. We've only got the top 3 players holding 35% of the market. So we think, and we've seen this literally in the last 3 months, Integral starting to consolidate the market. So they've bought capital. Their balance sheet's going to be a lot stronger post that deal because it was largely a scrip merger. So we think that Integral will continue to consolidate that market and get those market share gains. Finally, just digging in a little bit more to why the AI tools we think is a real edge that we have looking at this company. So if you think about looking at a scan, as a radiologist, it's a lot easier if you've got an AI tool flagging areas to look at on the scan. It's also allowing efficiency in workflow. So the AI tools actually run over all the scans and then push the scans that are the most ominous looking to the top. So prioritizing improving the patient outcome. So we think actually using these AI tools, the throughput of scans could increase up to 5-fold for some of these radiologists. So you're getting more revenue, you're getting more efficiency on that employee cost line and better EBITDA margins. So we think there's potentially a 25% uplift versus what the market's expecting in FY26 as a result of these AI tools. So again, this is a top 10 holding in the fund and one we're really excited about.
Some great ideas there. Thanks, Eleanor, and pretty relatively cheap valuations by the looks of it. Now, sort of just looking at history, how has the fund performed historically, and what are the costs involved?
Yes, so when we talk to clients, what we're targeting in terms of alpha generation is 7% per annum above the benchmark. Internally, we're targeting 10% per annum. And you can see on the left, that's the fund's track record since inception of Firetrail, which was February 2020. And you can see that the fund has delivered in excess of that 10% target at 12% per annum. And then you can also see the fund's track record on the right when Matt and I were working on the fund back at the Macquarie days. In terms of fees, so I think we're pretty cheap in terms of our management fee. So it's 80 basis points for retail investors in the pooled fund, which is below most of our peers. I think that's pretty market leading. And in terms of our performance fees, we do put a 2% hurdle. So we have to exceed the benchmark by 2% before we start earning a performance fee. So, you know, as we showed in that slide, the median active small cap manager has beaten the benchmark. So we think it's fair to put that hurdle upon ourselves.
Very good. Thanks very much, Eleanor. And if you'd like to learn a little bit more about how we incorporate the Firetrail's Small Companies Fund in our asset allocation strategies, you can contact us at ownfinancialplanning.com.au. Thanks for listening.